Welcome to today's exploration of one of the most transformative forces reshaping the financial landscape, artificial intelligence. The world of investing, once dominated by human intuition, paper trading tickets, and face-to-face negotiations on bustling trading floors, has undergone a radical transformation. Today, algorithms process millions of data points in milliseconds, machine learning models predict market movements with unprecedented accuracy, and AI-powered tools have democratized access to sophisticated investment strategies that were once the exclusive domain of Wall Street elites. In this video, we'll dive deep into how artificial intelligence is revolutionizing every aspect of investing, from how individual retail investors make decisions to how massive institutional funds manage trillions of dollars in assets. We'll explore the technologies driving this change, examine real-world applications, discuss the benefits and risks, and peek into the future of AI-powered investing. The evolution of investment technology. To understand where we are today, let's briefly look at where we've been. The history of investing technology is a story of continuous innovation. In the 1970s, electronic trading began to replace the physical exchange of stock certificates. The 1980s saw the rise of program trading, where computers executed large batches of orders automatically. The 1990s brought online brokerages, putting the power to trade directly into the hands of individual investors. But the current AI revolution represents something fundamentally different. We're not just automating existing processes, we're creating entirely new capabilities that didn't exist before. AI can identify patterns invisible to human analysts, process unstructured data like social media sentiment and satellite imagery, and adapt strategies in real time based on changing market conditions. AI technologies transforming investing. Machine learning and predictive analytics. At the heart of AI investing lies machine learning, the ability of computer systems to learn from data and improve their performance without being explicitly programmed. In investing, machine learning algorithms analyze historical price data, trading volumes, economic indicators, and countless other variables to identify patterns that might predict future price movements. There are several types of machine learning being deployed in investing today. Supervised learning models are trained on labeled historical data to make predictions about future outcomes. For example, an algorithm might learn to identify the characteristics of stocks that tend to outperform the market. Unsupervised learning discovers hidden patterns in data without predefined labels, potentially uncovering new investment factors or market segments that human analysts might miss. Reinforcement learning takes this further, with algorithms that learn optimal trading strategies through trial and error, much like a chess program that improves by playing millions of games. Natural language processing. Natural language processing, or NLP, enables computers to understand and analyze human language. In the context of investing, this is revolutionary. NLP algorithms can read and interpret millions of news articles, social media posts, company filings, earnings call transcripts, and analyst reports in the time it would take a human analyst to skim through a handful of documents. These systems don't just count keywords, they understand context, detect sentiment, identify emerging themes, and even recognize subtle linguistic cues that might indicate a CEO's confidence level during an earnings call. Some hedge funds are using NLP to analyze the language patterns in Federal Reserve statements to predict policy changes, while others scan Twitter and Reddit for early signals of trending stocks or shifting market sentiment. Deep learning and neural networks. Deep learning, a subset of machine learning based on artificial neural networks, has proven particularly powerful for complex pattern recognition tasks. These multi-layered networks can process vast amounts of raw data and automatically learn hierarchical representations, making them ideal for analyzing complex market dynamics. Deep learning models are being used to process alternative data sources like satellite images of retail parking lots to predict quarterly sales, or to analyze the technical patterns in price charts with superhuman accuracy. Some of the most sophisticated hedge funds are using deep reinforcement learning to create trading agents that can navigate complex, dynamic market environments and make sequential decisions over time. Applications of AI in investment management. Algorithmic and high-frequency trading. Perhaps the most visible application of AI in investing is algorithmic trading. These are computer programs that execute trades automatically based on predefined criteria. While algorithmic trading existed before modern AI, machine learning has dramatically enhanced these systems' sophistication. High-frequency trading, or HFT, takes this to an extreme. These AI-powered systems execute thousands or even millions of trades per day, holding positions for mere seconds or milliseconds. They exploit tiny price discrepancies across different markets, profit from minute-by-minute volatility, and provide liquidity to financial markets. It's estimated that HFT accounts for roughly 50 to 70% of US equity trading volume. Critics argue that HFT creates an unfair advantage and can destabilize markets during periods of stress, as we saw during the 2010 flash crash. Proponents counter that these systems improve market efficiency, narrow bid-ask spreads, and make trading cheaper for everyone. Regardless of one's perspective, it's clear that AI-powered algorithmic trading is now a permanent fixture of modern markets. Robo-advisors and wealth management. AI has also democratized access to sophisticated wealth management through robo-advisors. These automated platforms use algorithms to provide investment advice and portfolio management with minimal human intervention. You've probably heard of services like Betterment, Wealthfront, or the robo-advisory offerings from traditional firms like Vanguard and Schwab. Here's how they work. You answer a questionnaire about your financial goals, risk tolerance, and time horizon. The AI then constructs a diversified portfolio of low-cost index funds or ETFs tailored to your profile. The system automatically rebalances your portfolio as needed, harvests tax losses to minimize your tax bill, and adjusts your asset allocation as you approach your goals. The beauty of robo-advisors is their accessibility. Traditional wealth management services typically required hundreds of thousands or millions in investable assets. Robo-advisors often have no minimum investment requirement and charge fees of 0.25 to 0.5% annually, a fraction of what human advisors typically charge. This has opened professional-grade investment management to millions of people who were previously underserved by the financial industry. But robo-advisors aren't just for small accounts. Many wealthy investors use them for their tax loss harvesting capabilities and low-cost, disciplined approach. Some platforms now offer hybrid models that combine AI-driven portfolio management with access to human advisors for more complex financial planning needs. Risk management and portfolio optimization. AI excels at risk management, identifying, measuring, and mitigating various types of investment risk. Modern portfolio theory taught us about the importance of diversification, but AI takes this to a new level. Machine learning algorithms can analyze the complex, non-linear relationships between thousands of assets and economic factors to construct truly optimized portfolios. These systems can model tail risks, those rare but catastrophic market events that traditional models often underestimate. They can stress-test portfolios against thousands of scenarios, simulating how your investments might perform during various economic conditions, geopolitical events, or market crises. Some AI systems even continuously monitor portfolios in real time, automatically adjusting positions when risk levels exceed predefined thresholds. AI is also transforming credit risk assessment. Machine learning models analyze borrowers' creditworthiness using hundreds of non-traditional data points, potentially offering loans to people who would be rejected by traditional credit scoring models. This has particular promise for bringing financial services to underbanked populations. Alternative data analysis. Alternative data analysis 38. One of the most exciting frontiers in AI investing is the use of alternative data, information sources beyond traditional financial statements and market data. We're talking about satellite imagery, credit card transaction data, web traffic patterns, weather data, social media sentiment, shipping manifests, and countless other unconventional information sources. AI is uniquely suited to process this kind of data. Imagine a hedge fund using computer vision algorithms to count cars in Walmart parking lots across the country, generating real-time estimates of the retailer's sales before the official numbers are released. Or consider an investment firm analyzing millions of app download statistics to identify trending software companies before they appear on most investors' radars. Satellite imagery has become particularly valuable. Funds are using AI to analyze images of agricultural fields to predict crop yields, oil storage facilities to estimate supply levels, construction sites to forecast infrastructure spending, and even the shadows cast by buildings to verify information in corporate disclosures. This alternative data revolution is creating both opportunities and concerns. Those with the resources to acquire and analyze these data sources gain information advantages, potentially widening the gap between institutional and retail investors. There are also privacy and ethical questions about what data should be permissible to use in making investment decisions. Sentiment analysis and social media mining. The rise of social media has created a new and powerful signal for investors, the collective mood and opinions of millions of people. AI-powered sentiment analysis tools scour Twitter, Reddit, Facebook, news sites, and blogs to gauge public sentiment about companies, sectors, or the market as a whole. These systems go far beyond simple positive or negative classifications. Advanced NLP models can detect nuanced emotions like fear, excitement, uncertainty, or confidence. They can distinguish between genuine sentiment and market manipulation attempts. Some can even identify influential voices whose opinions tend to move markets or predict emerging trends before they enter mainstream awareness. The GameStop saga of 2021 demonstrated both the power and the challenge of social media sentiment in investing. Reddit's Wall Street Bets community coordinated to drive up the price of heavily shorted stocks, catching many professional investors off guard. Some AI-powered funds that were monitoring social sentiment were able to identify and profit from this movement early, while others suffered significant losses. This event highlighted how AI systems that can quickly process and respond to social media signals may have an advantage in today's rapidly evolving market landscape. ESG and impact investing. AI is also transforming environmental, social, and governance investing, or ESG. As more investors seek to align their portfolios with their values, AI helps analyze the vast amounts of data required to evaluate companies' ESG performance truly. Machine learning models can process corporate sustainability reports, news articles, regulatory filings, supply chain data, and other sources to assess a company's environmental impact, labor practices, board diversity, and governance quality. NLP algorithms can detect greenwashing when companies exaggerate their environmental credentials by comparing their public statements with actual practices. Some AI systems even predict which companies are most likely to face ESG-related risks, such as environmental fines, labor disputes, or governance scandals. This helps investors avoid companies that might suffer reputation damage or regulatory penalties, while identifying those that are genuinely committed to sustainable practices. Conclusion. The future of investing will not be humans versus machines, but humans and machines working together, each contributing their unique strengths to navigate the complex, ever-evolving world of financial markets. For investors, the imperative is clear: understand these technologies, use them wisely, but never abdicate your responsibility for your own financial decisions to algorithms you don't fully understand. The AI revolution in investing is not coming, it's already here. The question is not whether AI will transform investing, but how we will shape that transformation to create a financial system that is more efficient, accessible, and fair for everyone. Thank you for joining this exploration of how AI is changing the world of investing. The future is being written right now, in lines of code and neural networks, and we all have a stake in how this story unfolds.